Everybody, David Lenevieux with Rockmore Wealth Management. Today our topic is going to be real estate investing. Now let's clarify a couple things before we get into the subject. When you're investing in real estate, we're not talking about investing in your personal property. The primary reason for owning a home is to live in it. Now, while your personal home is a wonderful tax-free investment long term, it is not for investment purposes solely. The same goes for your vacation property. You're not buying that property as an investment purpose, you're using it and you're enjoying it. When we talk about real estate investing, we're simply talking about I'm putting my money to earn a rate of return on the piece of property I'm buying. Further, I want to clarify that we're not here to tell you whether or not real estate investing is right or wrong. We're not here to tell you whether investing in the stock market's right or wrong. I believe that both should be a part of your overall portfolio. What I do want to talk about here today is some of the risks associated with real estate investing that people may or may not realize. Now, here's an interesting stat for you. A lot of people have come up to me over the years and say, well, of course I'm going to invest in real estate. Look at what would have happened if I bought in Vancouver 15 years ago. We would have killed the stock market. Well, would you have? Let's take a look at that. So for clarity, when we talk about this, we're ignoring the costs of buying and owning real estate, and same with a similar comparable investment in the stock market. So if you were to have bought in Vancouver 15 years ago, back in 2005, and then you sold that property here in 2020, you would have seen a cumulative return of 170%. Hey, that's a great return. I agree with you. But what happens if you took that same amount of money and you put it in the S&P 500 Total Return Index, which is a very good indicator of the overall broad stock market? Well, over that same time period, your same cumulative rate of return would have been 229%. That's a massive difference. Once again, I'm not saying which is better for you, because I believe that you should own both in part of your portfolio. I just want to clear up some of the misconceptions that are generally held out there. Now, let's talk about some of the risks with investing in real estate, because there are a number of risks and there are reasons why you should be investing in real estate and reasons why, in my opinion, you shouldn't be investing in real estate. Now, one of the things that people talk to me about when they're investing in real estate is they say, yeah, of course I'm going to invest in real estate because real estate does and goes up in value over time. Well, I'm sorry, if you're investing in real estate for the sole purpose of assuming that that underlying piece of real estate is going to go up in value, you might as well just take your money and gamble in Vegas. Because when you're investing in real estate, you should be investing for the rate of return that you receive on rental income. And that's net of all your costs. And let's talk about some of those costs, because people don't always calculate all the costs. We're talking about your mortgage, we're talking about your repairs, we're talking about any management fees or property management fees you might have to pay. We're also talking about money that needs to be put away for future repairs, because that has to be factored in. And those are just some of the costs that exists out there. So you have to, when you calculate these rates of return, you have to calculate net of all those costs. But let's ignore all that for the minute, and let's talk about some of the other overall risks that people may or may not realize that exist when you're investing in real estate. The first one I want to talk about is concentration risk. So what do I mean by that? Well, let's take the average real estate investor, somebody that wants to consider investing in real estate, and let's just look at their net worth. So let's assume that they own their own home and it's worth about $600,000. And they want to buy a piece of property for investment purposes that's going to earn them a rental return, and that property is going to cost $400,000. And let's also assume they own a stock and bond portfolio and some other assets, and that's about a further $200,000. So they got about 1.2 million in assets. Now, of course, they're going to owe money on their own home, and let's say they own about owe about 50%, so 300,000. And if they're investing in real estate, they're probably going to put 20% down. So on that $400,000 home, they'll put 100K down, and so they'll owe another 300K. So out of their 1.2 million in assets, they owe 600,000 or 50%. Well, in concentration risk, we look at what your overall net worth is and how much is invested in one single asset. Well, let's look at that. You have $1 million out of your 1.2 million net worth in real estate. You've heard about don't put all your eggs in one basket. This is the definition of putting all your eggs in one basket. You have over 83% of your entire net worth in real estate. I don't care if you have that in stocks, in bonds, in real estate. If you have that much of your net worth in one asset class, you have major concentration risk. And I don't know if that's the type of risk that you want to be taking on. Now, couple that with the typical real estate investor, because they're going to probably own that real estate investment in the same city in which they personally live. So now you have all that real estate in the same province and in the same city. So now you're subject to geographical risk. Now let's take Vancouver Island. Obviously, we're subject to how BC does as an economy. We're subject to how Nanaimo does as an economy. But what else is a major risk in British Columbia, especially on the island? Well, earthquakes are. And actually, that's a massive risk right now. Now, you could say, well, what about owning in Calgary? Fine. You're subject to how the oil business is going to do over time. So if you're going to look to invest in investment properties, you might want to diversify the cities and provinces in which you own that real estate. Now let's go down the list. What are some other risks? Well, let's talk about leverage. Whoever recommended that it is a good idea to borrow to invest in the stock market? We certainly don't, because you're taking an inordinate amount of risk. So why would you do it in real estate? You have 600,000 or 60% debt ratio. You owe 600,000 on $1 million in assets. That's a pretty high risk. Let's go to some other risks. What about geopolitical risks? And what I mean by that is in British Columbia today, we have something called rental ceiling caps. And what that simply means is if I wanted to raise rents, well, I'm capped at the rate of inflation. So let's look at a scenario. If you're buying property in BC today, some will argue that property might be a little overvalued. Well, let's assume we found a great deal on a piece of property and we're taking advantage of the situation because we have record low interest rates. And let's assume we have our property already rented out. Well, the risk that we're going to come across is what happens if we're still sitting in a similar situation over time with COVID and the price of real estate starts to drop. And then all of a sudden inflation hits, which means interest rates are going to start to rise. So the cost of owning that property is getting greater by the day. And for me, I want to maintain a reasonable rate of return. So the only way I can do that is I have to raise my rent. Well, I just can't raise my rent to what the market will bear. I'm limited by the rental ceiling. So I can only raise it to match inflation. So I have a property that's decreasing in value, my costs are going up and I can't raise rents. Yeah, I've just hit a very negative situation very, very quickly. So these are some of the things that you need to be considering when you're buying that property that you want to invest in. And that goes hand in hand with another thing that we want to talk about, which is tenancy risk. So when most people buy a property for investment purposes, they're buying a condo, they're buying a townhome, or maybe they're buying a detached residence, and maybe we can get 2 or 3 different rental units out of it. Well, remember, our rate of return is determined by our rental income every year, net of all costs. So what happens when my tenant moves out and I can't receive a third of my rent or half of my rent for a couple months, and then I have to evict somebody, and then I have trouble finding somebody to rent that piece of property? all of a sudden my vacancy rent or my vacancy risk just went through the roof. My tenancy risk is really, really high because I only have 1, 2, or maximum 3 units. And if I lose some tenants, my rate of return for the year is shot. So you have to consider all these different risks when you're investing in real estate. Now, like I said before, I 100% believe in real estate as being as part of your investment portfolio. But when we look at real estate, we look at it a little differently. And what I would want to do if I were investing my money is I would want to be participating in purchasing large apartment blocks across economically diverse cities across Canada to mitigate all my risks. So how do I mitigate all that? Well, if I buy apartment complexes with 100 to 200 different doors, that's going to vastly decrease my tenancy risk. If I buy them in provinces that don't have rental ceiling caps, I take out my political risk. If I bought them across multiple provinces and multiple cities, I've decreased my geographical risk. If they make up only 20% or 15% of my overall portfolio, my concentration risk is mitigated. And finally, if I'm participating in a portfolio where we only have 33% debt or less, I've also decreased my leverage risk as well. So that's the way that I personally want to invest in real estate. Now, I understand that that's not available for a lot of the average investors out there, but you would be surprised because there are very many portfolio managers that do exist across Canada that do provide access to these types of investments for people. Now, how do I think somebody should invest overall? Well, honestly, I believe that investors should own a concentrated stock portfolio of between 15 and 25 of the best publicly traded companies that exist in the world. I believe that an individual should have fixed income that matches their risk tolerance and income needs. I believe that people should have private equity or privately owned businesses as part of their portfolio. And yes, I do believe that individuals should have real estate, as I just described, as part of their portfolio as well. Guys, thanks for listening today. We're going to have another subject next week. If you guys have any comments, questions, please feel reach out to us at www.rockmorewealth.com, and I'll look forward to speaking with you next week. Stay safe and stay healthy.